Good morning and welcome to the second session in this series of webinars from IMAP on alternatives and their role in managed account portfolios. Today we're going to be focusing very much on the defensive side of the portfolio, and I'll leave Daniel Stojanovski, our moderator, to take us through the sort of range of topics which we'll be covering today. But before I hand over to Daniel, let me just say a little about some of the other things which we have coming up over the next month or so within IMAP. So first, of course, on Friday, in 2 days' time, we'll be joined by presenters from the three research houses, Morningstar, Lonsec and Zenith, who'll be talking about the role of alternatives in managed account portfolios, how they think about them, how they use them, the sorts of considerations and constraints that they have regard to when they put together managed account portfolios. That will be a summary, really, of Monday's and today's sessions, and I'm looking forward to that. Later in the year, we'll be running three main events. We'll be, of course, presenting the IMAP Awards on the 25th of August. We would have liked to be live, but here we all are in lockdown. Then in September, we'll be releasing the results of our FUM census for the size of the managed account market. In December 2020, 95 billion or so. Let's see if we've gone through 100 billion for June 2021. And I'll be joined by Victor Huang from Millermans and by Praemium. And we'll be talking about the drivers for the managed account market and the trends and those things which seem to us to be shaping the development of managed accounts. And then in November, the first of our new series of events, Independent Thought, an opportunity for participants who are involved in portfolio management at the licensee or advisor level to get together and showcase their thinking about the way in which portfolios are put together when the portfolio manager really has an affiliation to an advice business. I'm looking forward to that. It's now my pleasure to hand over to Daniel Stojanovski. Daniel's the head of research for Centrepoint Alliance and the moderator for the whole series. So Daniel, thanks very much for joining us and taking us through this series.
Thank you so much, Toby, and thank you for having me. And yes, I'll be moderating this session too, the three sessions. So just some general housekeeping before we continue. So for everyone, Q&A will be, if you could look at the bottom of the screen, you'll see the Q&A box. Please just have that. If you have any questions, please click on that and send it straight through. We'll be able to all see those questions and hopefully get to them towards the end of the session. And in terms of what Toby had mentioned, we have been running three sessions over the course of this week. The first on Monday really focused on those growth-like alternatives. Today we'll be focusing on defensive or income. So those are defensive alternatives, or I guess alternatives to duration. This follows again on Friday, our last session, which will bring it all home, that the discussions we've had over these last two with all the major research houses, Morningstar, Lonsec and Zenith. So again, in today's session today, we'll be focusing on defensive-like alternatives. The purpose of defensive alternatives is to provide returns and risk similar to fixed income with low correlations to fixed income. At Centrepoint, we do, the purpose of these defensive-like alternatives is to provide a real substitute allocation to traditional fixed income. So, your duration and credit within the defensive component of a diversified portfolio in fixed income. These are usually fixed income strategies that are either unconstrained or absolute as an example in nature, and do provide flexible investment processes to broadly invest in fixed income markets. So without further ado, helping us today with better understanding this topic area and the specific options and strategies available, we have the following speakers. Let me introduce Alex Stanley from Ardea Investment Management. Alex joined Ardea Investment Management in July 2020 as a relative value strategist. Alex helps clients to solve investment problems with research and understand Ardea's unique relative value strategy. Alex has over 10 years experience in financial markets research. We have Brett Lewthwaite from Macquarie Investment Management. Brett is the global head of Macquarie Investment Management Fixed Income. He's also the CIO Global Fixed Income and the lead portfolio manager for the multi-sector credit portfolios, including the Global Income Opportunities Fund. Thank you, Brett, for coming along. And last, we have Matt Kaleel from Janus Henderson. Matt is a portfolio manager at Janus Henderson Investors, a position he has held since 2018. He joined Henderson in 2013 as part of the acquisition of H3 Global Advisors, where he was a co-head of global commodities and managed futures. Thank you, everyone, for attending today's session. So what we might do in terms of we might follow the same format as the previous session. So what we did there is have the speakers really present on what they're trying to achieve, the influences and the alpha they're trying to capture in their respective strategies. And then we'll follow on with discussion on the topic in general. So what I might do is just hand it over to Alex to start us off.
Thank you, Daniel, and thank you for the opportunity to join you here today. I'll start with a bit of a discussion around Ardea's investment philosophy, and then from there talk a bit about what the outcomes of that are for investors. So what is our philosophy? Our philosophy is around what we call pure relative value. So to start with, what is pure relative value? It's worth, I think, just contrasting that to the conventional approach to fixed income briefly. So a conventional approach to fixed income involves accumulating three sources of risk and return, and those are interest rate or duration risk, credit risk, and liquidity risk. So we operate in the same sort of space as those conventional approaches, in the sense that we focus on the government bonds and closely related interest rate derivatives. Our strategies don't take on corporate or emerging market credit risk. We operate globally within government bond and interest rate derivative markets, but we hedge all the foreign exchange risk, so we don't take on foreign exchange risk in those markets. Our approach for how we operate in the market is quite different to that conventional approach. So that conventional approach involves accumulating a portfolio to achieve the highest yield possible, or making active decisions based on subjective macroeconomic views or bottom-up credit views. So we do things quite differently with our focus on pure relative value. And basically what relative value investing is finding securities that have similar risk characteristics, but which trade at different prices, and implementing strategies to take advantage of those differences in pricing. So why do these mispricings exist? Well, a basic observation one could make is that if the world operated purely the way it does in textbooks and in theory, then you wouldn't see persistent relative value mispricings. But we all know that reality with investing is quite different to theory, and the reality is that this is a persistent source of alpha. So we think about pure relative value opportunities in government bond and interest rate markets as persistent, repeatable, and reliable. So they're persistent because they're structural market inefficiencies that drive the sorts of supply-demand imbalances that lead to relative value mispricings. And so these are driven by things such as regulation, differences in investor objectives, mandate restrictions, and there's a lot of other factors as well that are not tied to the typical macro noise and up and down movements for economic reasons. One of the big ones is that government bond markets, unlike many other markets, have large amounts of passive participation, and participation by investors that aren't seeking profit maximization. And it's the flows from these investors that typically contribute to relative value mispricings. These are repeatable opportunities in the sense that government bond and interest rate derivative markets that we operate in are very liquid and very deep. And that allows us to constantly rotate in and out of RV opportunities, because our strategy is not built around buying and holding securities for yield. It's around constantly recycling through large numbers of relative value opportunities. They're reliable sources of alpha because the relationship between the different securities is inherently constrained. So unlike, something like a long-short equity strategy, we have a constrained relationship between securities. A government bond in one part of the yield curve can only get so far apart from a bond in another part of the yield curve, which is quite different from the large potential idiosyncratic risk one takes with long-short equity or credit type strategies. So what are the outcomes for investors within our strategies, such as the Real Outcome Fund from Ardea? Well, some key facts. We target a performance objective of 2% over cash or CPI, so it's a dual benchmark. We have a history of returns well above that level. Our recommended investment horizon is 2 years. We offer daily liquidity in case investors require it, but we recommend a 2-year horizon. Importantly, we have a 2% volatility target. So we're not an absolute return strategy to the exclusion of all other factors. We are a volatility controlled absolute return strategy. So what does a 2% volatility target mean? This makes us ideally suited, we believe, as a defensive alternative. If you consider, a passive alternative, a passive benchmark strategy, the Barclays Global Ag, Ausbond Composite, something like that, the last few years, they've had 4 to 5% performance volatility. So we are a low volatility strategy. We have a structural inflation beta within our portfolio. So this gives some protection if inflation rises, but it's sized such that the main driver of alpha and returns is that pure relative value source of alpha. A couple of other important factors for investor outcomes that I want to mention before I finish. The first is diversification. So over time, we have a very low correlation with broader bond and equity markets. And that's due to the nature of the RV alpha that we're targeting. It's not dependent on macroeconomic forces. We don't require yields to be low or high. So yields are historically still quite low, very low. And that means that we don't need them to fall further in order to generate returns. It also means that if yields rise from here, we're still able to generate alpha. In periods of stress, we've had positive returns and actually some additional upside because of how we position the portfolio within volatility strategies. So historically, we've performed well when other parts of portfolios of our investors are performing poorly, such as equities. We've maintained low performance volatility through those periods of stress. And in particular, we've maintained continued daily liquidity in those difficult periods. I'll leave it there. Thank you.
Thank you so much, Alex. And I might get Brett next to take us through some of these slides. Thanks, Brett.
Yeah, thank you. Thank you, Daniel, and thank you, everyone, for coming along today. So I'm Brett Lewthwaite, the Global Head and CIO of Macquarie Fixed Income. What I thought I would do today is talk about, in particular, the Macquarie Income Opportunities Fund, but also a couple of other strategies that we've been thinking about in relation to this sort of prevailing very low yield environment, and have been thinking about for quite some time, just to raise awareness about a couple of those as well. We've brought along a few slides here, really just to sort of aid, I guess, the discussion. But I think in many ways, I guess the way we would start is that I guess we've been thinking about this prevailing very low yield environment for quite some time. In many ways, I guess, really putting ourselves in the shoes of the clients and looking at the reality of the situation, asking some serious questions around, I guess, the way that many people have approached investing in fixed income over the last sort of 25 years in particular, as we've seen the Australian superannuation system grow and grow and grow. And, in many ways, a lot of the things that we all believed in back then in terms of balanced portfolios or the way benchmarks should have been adopted, they were point-in-time analysis, and they've just really carried on year after year after year. And here we are in a completely different environment, and some of those tenets probably don't hold anymore. But I think the other interesting thing from our point of view is that I guess anyone who will have come along to our presentations or some of the presentations we've done over the years will know that we were sort of always out there talking about this concept of lower for longer. And the slide pack we have up here is really just pulling out some of the slides we used over the years. And I think as we went along, I'm not sure that the presentations were necessarily that popular. I think at times they were fairly abrasive, because I think in many ways we were trying to describe that while the environment was very unusual, while we were seeing more and more unthinkable monetary stimulus, and more people, I guess, were very fearful of things like inflation, our view was generally that the real structural influences out there being massive indebtedness, those slow moving but very real demographic issues, more recently the acceleration of digitalisation, this acute dependency we're seeing on ongoing central bank stimulus and QE and the like, as well as changing nature of the global economy, a move away from globalisation. All of these things were really going to make it difficult to move away from a disinflationary environment. And the thing that would continue to surprise everybody was that yields would get lower and lower and lower. The environment would become more and more unthinkable. And those sorts of things, aren't necessarily easy to say or popular here. It's not what everyone wants to be listening to. But in many ways, this all panned out pretty much very well. Now, that's not to say we saw a pandemic coming. Of course, we didn't see that. But ultimately, it really just sort of came at the end and pushed things further along again. But in the background, we were saying to ourselves, we genuinely believe this. And we were saying things like, rates will go to zero. And at the time, most people, I guess to some degree, thought there was some level of craziness around it. But it was genuinely based on all this evidence we were looking at. And so in the background, we're saying, okay, well, that's all good and well to have this view. But when we get there, everything's going to change. And it's no good waiting until we get there to then sort of say, okay, what sort of things are clients going to need? What sort of things could they be attracted to? And so the real story about this is essentially how 6 or 7 years ago, we started really thinking deeply about how you would manage portfolios to develop, as Daniel was saying earlier, fixed income like returns, but in a very, very low yield environment. One of the things we hear quite a lot is, I guess, this sense that any time now inflation is going to appear. Some of the things that have led us to this point ultimately will somewhat mean revert or explode higher. And quite possibly, the reason for having things like fixed income or income sourcing assets in your portfolio no longer add up. We struggle to see, that fear really coming to fruition. And so I guess what we're really talking about here is not so much preparing for something that may not happen, but more adapting to an environment that may go on and on and on. And I think that's a real subtle difference. So in a lot of ways, you'll see us thinking about how we construct portfolios. It is sort of embracing this concept of cash rates probably being low for a very long time. Sure, bond yields might go up and down. Maybe there's a little bit of inflation pressure here and there, but most of those structural issues really haven't been addressed. They're getting bigger all the time. And society just doesn't seem ready for a significant shift towards greater government involvement in economies and rebalancing some of the inequalities we've been seeing. So with that in mind, and if we go to the next slide, 6 or 7 years ago, we were looking at what we were doing for clients, and some of those things were already a purpose fit. So the main strategy that everybody, I guess, associates with people like myself with is the Macquarie Income Opportunity Strategy, and that's on the bottom left-hand side there. We developed that all the way back in 2003, so it's been 18 years now. We've been running the strategy, and it really was about creating an alternative fixed income solution, one that didn't rely on exposure to bond yields or duration, but still delivered fairly stable fixed income-like returns. And we did it all the way back then because people didn't really enjoy the volatility that came from bond duration. And as yields got lower and lower and lower, and the fear about the potential rise in bond yields got higher and higher as well, I guess the attraction to that strategy, which is very flexible, very low duration, you don't need to be concerned about movements in bond yields, really sort of grew and became very popular. And that strategy throughout that 18-year period, has sort of delivered around that sort of cash plus 2 to 3% area, with very few pockets of volatility, but the odd one here and there. And we thought to ourselves, well, that continues to be very relevant, and I think the key message is it still does today. But we also asked ourselves, is there other things that in a very low yielding environment, people will either need or may be attracted to? The first one that we thought about there was the extension upon the Income Opportunities Fund, which is more around what we say there is the Multi-Asset Opportunities Fund, which is in effect a fund very much similarly managed to the Income Opportunities, low duration, very flexible in where it can go all around the world. But it has the addition of things like alternatives, limited use of equities and the like as well, to sort of deliver closer to that cash +3 and all the way up to cash +5%. And it has a really fantastic track record since we've been running it for about 7 years now. So well in excess of those numbers that we're talking about, and utilising those methods that everyone's familiar with, income opportunities. And so in a way, we sort of thought, look, in a very low yielding environment, perhaps people may want more. And so that was the genesis behind that thinking. So how do we do things like income opportunities that people have very much enjoyed being part of, but perhaps offer a couple more percent if we can, utilising similar methods? The other thing we did is think about the traditional fixed income portfolio. And for this, I just wanted to raise everyone's attention around what we call the Macquarie Dynamic Bond Fund. So I think in many ways, the comments we've heard earlier about, is a traditional fixed income portfolio the way to go in this very low yield environment? I guess there are a number of reasons why that may no longer make sense. For example, back in 25, 27 years ago, as superannuation was really getting underway here, I mean, who determined that fixed income benchmarks should be around market cap or biggest issuers? So things like the Composite Bond Index or the Global Aggregate Index were really just arbitrary indices that people measured themselves against. I'm not sure they ever really had a purpose around matching liabilities or necessarily reflected what you would otherwise think as sensible fixed income exposures. But nonetheless, over the last 25 years, they were the most popular, things to measure people against. And as such, many portfolios continue to be managed to them. But ultimately, those strategies have extended further and further in terms of longer and longer in their exposure to duration or bond yields. And that just no longer seems like a particularly relevant strategy in a very low and in some instances even negative yielding bond world. And so we threw that out about 6 years ago and said, we don't want that benchmark. We still want a fixed income like portfolio, but rather than let the index tell us what we should own, let's utilize something like a 5-year duration component in the portfolio. But again, not let the index say, well, some of it has to be Australia or some of it has to be Japan or Germany. Why would you own things like that make no sense? And so we said, not only will we pick the duration level, and it'll be a duration level that makes sense in most people's portfolios to balance out some of the other risks that take place in a more well-rounded portfolio, but we would only own the duration we really wanted. And then on top of that too, to somewhat simplify things, we'd utilise the sector rotation and that very large team of over 120 people we have all around the world to find really good credit opportunities to sector rotate in and out of. And so in a way, create a sort of more sensible bond solution, and the word we use there is dynamic, to really sort of create the bond fund for the next 10 years. And in our mind, in many ways, this environment we're in could well be going on for that long. I know that's not necessarily the most exciting news, but as we've sort of tried to highlight here today, our mindset is really around embracing what's going on and asking ourselves, how do we really try and extract sensible solutions that continue to fit that fixed income profile in an otherwise yield constrained world. With that, I might hand it back to you, Daniel.
Thank you, Brett. That was great. I might hand it now to Mathew with his presentation.
Thanks, Daniel. So yeah, thank you to the previous speakers as well. It was a very good summary of the current environment. We are all seeing these secular challenges. We're seeing things such as COVID impacting portfolios. There's a whole host of longer term challenges that abound. We have a low yield world, we have debt, we have demographics and technology impacting everything. Traditional portfolios, in our view, need all the help they can get from genuine, alternative, diversifying sources of alpha. The product that we will be covering today briefly is the Janus Henderson Global Multi-Strategy Fund. This was set up many years ago and has been run in its current form since January 2012. The objectives are quite simple: to provide variable sources of alpha from global markets that aren't reliant upon traditional bond stock market beta. You have enough of that, with your current portfolios. You need something different. The fund targets returns, gross returns of cash +7, and sits in a volatility range of about 4 to 8%. So at the higher end of volatility, but definitely in the defensive bucket. When we look at the way the fund operates, the way that we seek to generate alpha in a truly different way, we utilize a number of skill-based investment strategies. We have a global team in Australia, Europe, and the US. We have 6 strategies that we operate within that to get that true diversification. The first 5 of these are risk-on strategies. These operate when markets are operating normally, when the opportunities are sufficient for us to take advantage of these mispricings, these behavioural anomalies. And within that, when we look at things like convertible arbitrage and fixed income price pressure and the trend following strategy within the portfolio protection sleeve, there's a whole host of fixed income trading that occurs that is quite different to what you'd get in a traditional portfolio. That 6 strategy, portfolio protection, really is the key for the fund to be able to operate through the strategy. We believe this is a pretty unique feature. It's there to protect the fund itself in periods where markets more broadly become stressed. And look, whether you're looking at this or any other product to add to your portfolio, the first real question you have to ask is, how do these strategies perform when it counts, when markets are under stress, be it in bond, credit, or equity markets? The fund has achieved its twin objectives since 2012, firstly delivering defensive absolute returns, very predictable, but secondly, delivering real diversification when it really counts. If we go to the next slide, thanks. And in the end, what we would like to add, and any manager here, we need to add true diversification. If we can go back one slide, sorry. Thank you. This highlights negative markets in global equities since 2012. Significant stress, and in particular, what we'd like to highlight on the left there is how quickly, and we all recognised how quickly and sharply markets fell in February, March, and April, and that recovery was just as sharp. I think it's quite important when you're looking at a fund to look at what it does when it counts. And thankfully, since 2012, the fund has been able to deliver on those objectives and protecting portfolios. What we wouldn't like to do for you as an investor is add to that downside. If we can go to the next slide, thank you. More specifically, when we look at bond and credit markets, again, when these markets become dislocated, the fund is set up to hopefully take advantage of this dislocation and stress. That protection element that I mentioned has really added value, but it's added value to allow the other strategies to perform. So when we see those stressful events manifest, spreads widen, discounts deepen, if you have the capital to deploy and you're not impaired, you can actually step into the markets in these environments and hopefully deliver these types of returns. So very pleasingly, we've been able to deliver relative outperformance in all markets, but more often than not, absolute positive performance. If we go to the next slide, thank you. None of this comes without taking risk. All of these strategies, any strategy that you are looking at, involves some level of risk. What this shows is the quarterly returns for the fund. And what you can see there quite simply is that there is risk in every strategy. And in each quarter that we look at, the fund has a negative return. There's obviously ample opportunities to generate alpha, but risk can manifest in any number of ways. You can have that at a trade level, at a strategy level, or at a macro level, something that we saw last year with COVID. We've tried to set the fund up to be genuinely diversified when it counts. And when we look at that chart here, when you look at those circled periods, these are periods of greater market stress more broadly across most asset classes. The circled areas highlight one thing. This fund, as with all others, will have issues in certain market environments, but when you calibrate the structures properly and you calibrate the strategies properly, you would hope to diversify away some of those risks and generate some positive returns. And what you can see there, which is key for this fund, is that protection element really kicking in when it counts. Part of that is utilising options. Part of that is utilising a trend following strategy, which can be long and short across all asset classes, including bonds. And most recently, when we saw that sell-off in February, we had a decent short position in bond markets. So, we're relatively agnostic when it comes to inflation, disinflation, reflation. What we like to see is that the fund is set up appropriately to cope with various regimes. I guess the environment where the strategy has the greatest opportunities for alpha generation, where you have those benign environments. We look for higher dispersion and volatility across all asset classes. Strategies such as event-driven and M&A strategies, that's more related to deal flow. We have exhibited a low correlation to both bond and credit markets. If we can just go back a couple of slides, thank you. Oh, sorry, one more ahead. That one there, thank you. The bottom of this slide shows the correlations to various asset classes through time. Most critically, low correlation, low beta. We try as much as we can not to be exposed overtly to any bond, credit, or stock market beta. The final attribute, when diversification counts, you can generate profits, but also there has to be liquidity there. And the fund offers daily liquidity, so you can rebalance as needed as part of a broader portfolio. And often what we see is we're utilised as a rebalancing mechanism where people need to reallocate to other strategies, but that liquidity is key. And we predominantly stick to very broad, deep liquid markets to be able to offer that liquidity profile. So in the end, this fund is targeting bond-like volatility at the higher range, cash +7 on a gross basis, and very low correlation and beta to major asset markets. I'll hand it over to Daniel at that point, and thank you for listening.
Thank you, Mathew. And I think I'll just open it now to a discussion, I think, with everyone. And on that, I think this is a question that also came through specific to Alex in the past, but Alex and Ardea, but in general, and something we wanted to get a little bit more light on from everyone was what kind of market environments would be supportive of your strategies, and specifically, where would you struggle compared to bonds, and really starting it off with that. Alex, maybe you can start us off.
Yeah, sure. It's a good question and an understandable one. So what I outlined before is we don't take conventional duration or credit risk, but relative value is still risk in of itself. It's just a different kind of risk, and it's one that's less correlated with those traditional macro factors. So our real outcome fund has been operating since 2012, and there's been some very different market conditions during that period. So higher rates, lower rates, high volatility, low volatility, and there's been a consistent alpha that's been delivered. So what I would observe, two observations I would make around those ideal market conditions, and the flip side of that, what are the worst market conditions? What I've found, what I can observe, and we can see this in our history of returns, is that the immediate aftermath of periods of stress, COVID, the 2018 sort of Fed-driven dislocation of equities and bonds, the immediate aftermath of that's been really good for relative value. What you often see, whether rates are rallying a lot or selling off a lot, is market participants will hit those liquidity points, or they'll say, get me out, and they leave a lot of mess behind. And that mess is those relative value distortions. And so that's a really great time for us to be deploying risk. Now, if I think about the flip side, what is a really bad situation for us? One that we could conceive is that if everyone, every country in the world had a similar setup to Japan, where you had really, really low, almost zero volatility in rates, yield curve control that's not like the yield curve control we have in Australia out to 3 years, but it goes further across the curve and there's no movement at all. That would be a really hard environment for RV, just because you would have to run really, really hard to get those alpha opportunities. But that's quite an unlikely environment. And it's not the same environment as we've had the last year, where we've generated strong RV alpha with negative rates and with QE everywhere. So we require some volatility. It doesn't need to be high, it just needs to be non-zero.
That's great. Brett, did you want to weigh in on your thoughts on this one?
Yeah, I mean, I think the interesting thing from, I guess, our strategies is they're all lower duration. So in the event that I guess we continue to see bond yields go lower, which is definitely possible, and there's no reason that the last remaining positive ones couldn't at some point go negative. But because of the, we're not as exposed to duration, then perhaps you would be able to underperform bond funds in that period. I think we'd all agree that, yes, by all means, bond yields can go lower, but they're sort of probably limited in terms of how much further they can grind. And there probably be returns that would all be somewhat happy that, not that bothered, I guess, if we missed them. So we're not, particularly concerned, I guess, so much around how things might perform, say, versus traditional bonds, that these things happen. I think through time, the far greater array of opportunities that we can identify more than offset that opportunity lost, if you like. Look, I think with anything, the market environments that might make performance a bit more challenged would be a situation where both, I guess, risk markets and bond markets are both underperforming or performing poorly. I mean, that's quite rare, and everyone talks about that possibility, and there is the odd pocket where that occurs. But again, generally because we're managed with a fixed income-like mindset, not an absolute return go anywhere or hedge fund-like strategy, it's very unlikely that any of the strategy we're going to do are going to be something that you're majorly concerned about. I think in that event, it's probably the riskier components of most people's portfolios that really would capture their attention. I think most people would be fairly relaxed by the modest downside you could see in some of the things we're doing.
Perfect, thank you. And Matt, just your thoughts on this one?
Yeah, look, we as I touched upon before, we tend to look at deal flow and activity. That's quite important. And Alex mentioned that, if you had this slow grinding environment with fewer opportunities, that would be more of a challenge. We've seen that in the last few months. Our returns in the last few months are relatively lower than the last year. That's more to do with the fact that there are less opportunities than was the case a year ago. So, we take some duration risk for short periods. A market shock, a sudden market shock where we were positioned in a certain manner may impact the fund, but we don't take a lot of risk at a trade level. So we try and diversify those risks away. But it's more a low yield, grinding, low vol environment with fewer opportunities and less dispersion. That would be more of a challenge.
No, perfect. I think a lot of, I think in the presentations you've answered this next question that I sort of had, but I still think it's important just to be really clear on this one around rates, where they're going, potential inflation. I know, Brett, you mentioned lower for longer, and Matt, you did speak about this environment that we're in as well. But just to be really, I guess, sure about this in terms of from a client's perspective, you do see that lower for longer. That is the messaging in general that you're looking at. There's potential. There's a lot of headwinds for anything else. Brett, did you want to start us off?
Yeah, sure. I'll start off with that. I mean, yeah, look, it's not the most popular storyline, right? Is it? But look, all the things that created the lower for longer environment, and they were all there at the end of 2019. If you look at them all now, now that we've had a global pandemic, is that most of them have accelerated. In fact, indebtedness has gone vertical. The use of digitalisation, massive amounts of central bank intervention in markets, more and more unthinkable. I mean, that hasn't gotten better. It's gotten a lot worse. So it's hard to imagine how we could break out of this environment if those things are much, much worse, not better. I think a lot of people look at fiscal policy and that change there as perhaps the tide is changing. And I think that we have to pay attention to that possibility. I think in our mind, the amount of rebalancing that needs to take place to really start to push against those disinflationary forces really mean that fiscal policy is going to have to be really big. and it's going to have to go on for a very long time. Has to be targeted, creating proper jobs, so greater government involvement in economies, and there's a lot of push against that, and probably has to be quite global. And so perhaps we're seeing that shift, but our sense is that it's probably a bit too early. Society's not really ready yet, and that's kind of how things continue to play out here. But nonetheless, as we continue to sort of get closer and closer to that dependency on zero rates and ongoing QE, I guess the need for a shift in that direction is going to come, but it may be, abrasive. I think most people forget that, fiscal policy is not monetary policy. Fiscal policy is about government, and government's all about politics. And in this day and age of social media, it's very, very difficult to get a mandate to do things for big enough and long enough. And so unfortunately, that leaves us in this world where we've got this massive debt overhang, and we need very low rates and an ongoing central bank to maintain stability. And unfortunately, that's probably what we're going to continue to see.
And Matt, your thoughts as well on this one, very similar in terms of what you're thinking, or anything?
I mean, the long term, the long term drivers are deflationary, no doubt. But when we look at commodity markets, for example, we're seeing, as Brett touched upon, mandated reductions in carbon emissions. That's so we're seeing a higher carbon price. There's a cost to doing business. We're seeing certain parts of the resource sector cut out of getting any new financing, and that in itself creates some form of potential for commodity price inflation. Other sources of inflation, it is really hard to see things getting completely out of control, but it's a very difficult period where you will need some form of government support for some time. But we see pockets of inflation in areas like commodities, and that could be something more longer lasting as opposed to the other forces which are more deflationary.
And Alex, just adding on that one, your thoughts regarding this?
Yeah, so I mean, we sort of have the luxury of not, depending on macro forecasts or duration calls for our strategy. But I agree with the points being made. And, if you've been a sort of permanent or structural bond bear or inflation hawk, it's probably been a very humbling experience the last 10 years, So the burden of proof really is on those that have that view to say why this time might be different. And I think some of the reasons that Brett mentioned, some sort of permanent union between monetary and fiscal policy would be one reason to expect, some higher inflation down the track. One thing I would add on that front is that inflation uncertainty is higher than it's ever been. Whether the pandemic also leads to some structural changes in product markets that could get you some sort of inflation, but again, whether that gets you the kind of wage-driven inflation that gets you 3% plus year-on-year CPI, which is what most investors really worry about, that's a much harder thing to see. What I think we could see, though, is periods of central bank, more cyclical type moves in bond markets where central banks are, incrementally tightening things up here or there. Bond markets are not well prepared for it. You get a reset higher in yields, and then you perhaps resume the structural trend again later at some point. It doesn't mean it's all one way, but nor does it mean that yields are going to be much higher either.
And just on that, and thank you, everyone, for your thoughts on this. But just on that, I think a question that has popped up from an advice perspective, but just to get your general views on this is, can fixed income or defensive alternatives justify their fee load with falling rates or that lower for longer over time? I think just getting some of your thoughts on this. Matt, did you want to maybe start us off?
Yeah, look, I think that comes down to, and for all of us, it's obviously the same. It's the opportunity set. It's looking for things that are different than what has been done traditionally. There's less opportunities in that traditional space. We look to diversify through asset classes and by taking on risks across a lot of trades. We don't have a view. We try not to have that explicit beta, but look, I think in the end, it comes down to each strategy being able to take advantage of those opportunities as they present themselves, and we all run strategies in a different way. The way we do that is through a lot of opportunities in a lot of asset classes in an agnostic manner.
Yeah, I mean, maybe I could add on to that. It's kind of interesting, isn't it? In many ways, some of the trends that we've seen over the last 10 years or so too, with a huge attraction to lower cost and passive type products. Everyone's a macro trader, when in fact I think central banks have probably been the main force that have made everyone feel very skilled at investing. But it's quite interesting now, because when you really look at that trend, we've gotten to a point now with some of the, why do passive or low fee things that are index hugging when maybe the indices just aren't, purpose built for the way ahead. And I think when we were sitting there thinking about what would be attractive to investors at a point where yields are very low, actually it tilts more back towards manager skill or opportunity, or the ability to adapt to the environment. And so in some way, I think that the point is very well made, and you would answer, some of the things that people have been very attracted to in the past probably don't make sense anymore, but it has evolved, and you definitely try and evolve your fee budget to sort of take advantage of a different way of thinking about doing fixed income, I think.
That's great. Alex?
Yeah, I would agree with the points that have been made. The conventional strategies have gotten, passive alternatives have got longer and longer duration, and they've gotten, more and more credit heavy with spreads at really, really low levels. So following that passive alternative to the defensive part of your portfolio gives you more risk at a time where things are very expensively priced. Seeking an alternative that doesn't depend on that huge tailwind continuing to float all boats, I guess, the big tide that floats all boats, central banks, is a compelling alternative.
That's great. I think just to open up some of the questions that have come through, specifically, the investors are really, there's a clear hunt for yield out there. Is there any, I guess, considerations in any of your portfolios around, I think it's mentioned here, emerging market opportunities, or any other opportunities around that yield sort of perspective? Get everyone's thoughts on this one. Alex?
Yeah, look, I think in terms of emerging markets, because we're not dependent on level of yields, and our strategy requires high levels of liquidity, I think it's unlikely that we'd ever go down the road of an emerging market. And within our mandates, there are a number of countries that we are allowed to invest in, but we don't, for the reason that we don't see the compelling relative value opportunities in them. So we think there's plenty of return potential still in large developed bond markets and interest rate derivative markets that are developed markets.
Brett?
Yeah, look, we see emerging markets as part of the investable universe. We've got a really skilled team. We get our allocations to emerging markets through a very similar strategy to income opportunities, which has been designed wholly around emerging markets. So in many ways, it really fits nicely. But as we've done throughout the life of the strategy, is if there's really attractive opportunities in emerging markets, we'll allocate. But ultimately, if there's no reward, we sit back at zero. So it's not something that's a permanent component of the fund, but definitely part of the selection process that we'll go through in terms of trying to ensure that returns stay at an attractive level.
And Matt, your thoughts?
Yeah, we don't have a significant exposure to emerging markets right now, and we think there's significant opportunities in the developed markets that we trade. We don't rule them out, however. But having said that, it would be a decision based upon liquidity, perceived risks, and constraints within the fund. So if there are opportunities in the larger emerging markets, we definitely consider them.
Great. And I think there's just a question, given that this is all about alternatives and this series is all been about alternatives, just a question on how do you compete, and this is a big problem in portfolios as well, but how do you compete with the return on income characteristics of, let's say, private debt in portfolios? And I understand a very different segment, and it probably more sits within that growth side of the alternatives bucket. But how do you sort of compete with those types of strategies in portfolios with your own, given that there's obviously that continuation of what investors are really wanting going forward?
I think one thing from our perspective we'd say is, and look, I can see why they have a place in a portfolio and why that place has grown with yields low and credit spreads really tight on investment grade credit. One thing I would say is that one would have to consider, and while they are part of a portfolio, one would have to consider how they might perform in a stressed market environment. And what you want from your defensive alternative in a stressed market environment, or the defensive part of your portfolio, is that positive performance in those environments, and it's liquidity as well. Can you get that liquidity at those times when you really need it? And I think that's where a strategy like ours, RV focused in deep and liquid markets, has strong advantages. I mean, we maintain daily liquidity through the COVID crisis, for example.
Matt or Brad, did you want anything to add on that one? I think that's probably a good point, Alex, but anything specific else to add around that?
Not a lot from me. I think Alex has summarised it well. You really need that liquidity when it counts, and we've all seen this. We've all seen, everything has a place in a portfolio, but it's appropriate sizing. And if it's private debt, that's fine. It does something for the portfolio from an income perspective. But just being cognizant of the fact that at certain points in the cycle, that liquidity won't be there. We don't compete with it. We'd hope to be complementary and offer that liquidity when it's needed.
Yeah, look, I mean, it's interesting, isn't it? I think when you think about the structural environment, I think it is dominated by, this very real absence of yield. And as the absence of yield environment has gotten more and more acute, the more and more we've become fascinated, I guess, with all these other ways of perhaps lending and extracting yield. And I think you just got to be careful. There's so many different areas that you could deem as private credit. You're really looking for expertise in those areas, and there's definitely some really good ones out there. There's some other ones that are just a play on the fact that you've got an ultra low leverage cost environment, and if that cost of leverage ever goes up, those extra small basis points you're earning in income could easily turn into significant capital losses, and we probably shouldn't lose sight of that.
No, totally agree. I think that's well-rounded responses on that one. I guess cognizant of time as well that we've slightly gone over, but what I wanted to really sort of get to this in terms of the last type of question. I've had a look at some of the other questions that have come through, but can we really get positive returns after inflation? Let's say inflation did come back, can we get positive returns in the strategies in general going forward?
Yeah, I mean, I would think so. I mean, I think in many ways it's one of those things where I think everybody generally is fearful of the thing that will change the environment, which is, I guess, inflation and the higher cost of leverage, these sorts of things. It would change so many things. I think so many people forget that if indeed you got that, the fact that you've spent the best part of 30, 40 years, depending on monetary policy and allowing a proliferation of debt to lift asset prices, the change that would occur across so many assets would be so profound that, it's really be careful what you wish for. But that's the fear factor. The reality factor is there are examples out there where economies have struggled with indebtedness, with creating sustainable levels of growth, inflation, these sorts of things that have gone on and on and on. And you're seeing QE 3, 4, 5. Where's Japan at now? And everyone dismisses the possibility that so many of these other economies are on the same track when it actually looks like they are. And so, I think generally, yes, inflation, and we're in a pandemic, it's very strange. It could pop high for a while. From a long-term investing point of view, I feel pretty comfortable that, we can outperform inflation quite comfortably.
Yeah, also comfortable that we can outperform it, and we actually have structural and exposure to inflation-linked securities within our portfolio, although it's smaller relative to our RV strategies, which are the dominant source. Just a couple of comments I would make around the general market environment, and Brett's touched on some of this. I think when you think about inflationary environments, the details matter a lot. So the velocity of the move, how sustained it is, what's driving it, are things that all matter for your portfolio. And one very basic observation I could make about history is that if you think about a traditional 60-40 portfolio, it's really the 3% and rising inflation environment that does the damage. It's not the 2% and going up a bit, or 3% even and falling. That's actually tended to be a tailwind for traditional assets. The other point, and I think Brett's made this well, is just that, central banks know what to do when inflation's going up. They have the traditional policy tools at their disposal. I think they've been more worried, and rightly so, about inflation undershooting, because then you have to dig deeper into the toolkit.
Matt?
Yeah, I mean, that point about the type of inflation and persistence, the 1970s is a good test case where you had persistently higher 3% readings or higher for 5 to 6 to 7 years. And that really destroyed, when you look at the real returns in that period for a 60-40 portfolio, absolutely destroyed it. So, yeah, and Brett touched upon this, there would be more serious considerations if you had low growth with inflation for an extended period. It's not something that would be pretty for any asset class. As with the others, we do consider this. We have the ability to take positions. We can be short bonds as part of our protection strategy. So, it's something we're looking at actively.
No, thank you. And I think we're nearing now to the end of the presentation. I think there was just one small question here that I thought I might quickly answer as well, given how we use these types of strategies in portfolios and how we're blending defensive-like alternatives in that defensive bucket or within fixed income. And without it, if anyone wanted to add it specifically, but from our perspective, it's always been these types of strategies, or defensive alternative like strategies, are really providing defense to your duration that you have in portfolios, and that's, I guess, where you'd start and work backwards from there. But hopefully that answers that question. But I might hand it over to Toby, who couldn't get through all the questions, but yeah, thank you.
Great. Look, thanks very much, guys. That was really interesting, and I think it addresses probably the major issue which advisors and investors that rely on them are asking, which is, these are not normal times. These are not normal interest rate environments. These are not normal equity rate environments. And how do I meet my income goals? And how do I get the sort of defensive protection that I would anticipate from the defensive part of my portfolio? So Daniel, Alex, Brett, Matt, thanks very much for your time today. On the screen, just a reminder of the upcoming webinar on Friday with the research houses, talking in a more broad sense about alternative strategies and the way they think about them in portfolio construction. So I'm looking forward to Daniel joining us for that session. Thank you for attending today, and we look forward to seeing you all on Friday. Right. Thanks very much.
Thanks, everyone. Thanks.